Bienvenido a Finance with Avery. In this video, I want to give an analysis, overview, and review of the top 5 dividend stocks that I've been buying lately and that I plan on buying more of soon. Even though this market has been on an uproar lately, especially thanks to the top 8 tech stocks that have really been leading this market up, the Nvidia, the Meta, Apple, Microsoft, Alphabet, the fabulous 8, some FANG stocks or MAGA stocks, they go by different names, with the acronyms and everything like that people like to call them. But yeah, they've been leading the market higher, and then, other companies have been joining the fray as well. But some of these other companies I've been having my eye on in my portfolio haven't been going up as much. Some of them are actually kind of down year to date or down for the past year or so. And some of them are still not even at the level I have my average cost at. So I'm having to raise my average cost some a little bit. But I definitely want to add to these stocks during while they're down and everything, because this market could keep going up and bring these stocks up higher, or it could definitely go down, because there are several factors that affect stock prices. Macroeconomics and microeconomics, the interest rate, inflation, the Federal Reserve, what Jerome Powell says, what the president says, what's going on internationally. All kind of things can affect stock prices that have nothing to do with the actual company themselves. But of course, there are things within the company itself that happens with it that affects the stock price, like the earnings and news and institutional buying, insider selling, insider buying, technical, analysis. There are various different things that affect stock prices outside of the realm of the company and inside the realm of the company. So this isn't some kind of video saying, hey, buy these 5 stocks, everything's gonna be great in your dividend portfolio or something like that. This is not financial advice. This is personally what I'm doing. Me personally, like I say, with these stocks, I own all 5 of these. But without further ado, let's jump into this top 5 list. And first, I'm going to start with CVS Health. Now, CVS, you see them all over the place right there. So chances are there's a 99% chance you've seen a CVS. You pass by one, you've been in one, maybe 90% chance you've been in one. I don't know. But, so CVS Health is more than that retail location, though. They're more than retail pharmacy for sure. They are a mega corporation in healthcare. The market cap of CVS is $91.5 billion. They are a huge company in the healthcare realm and a huge company in general. Of course, they have the retail locations with the pharmaceuticals, but they also have health insurance because they bought Aetna a few years ago, so they provide health benefits. But they got the locations with the Minute Clinic, so they have that kind of healthcare situation going on as well. They own other entities as well besides CVS, and they pretty much brought them underneath their umbrella with CVS. So CVS is growing. You see them even inside of Targets. So yeah, they don't own Target. Target doesn't own them. We'll provide our services within you. They both benefit from that. So CVS is definitely a major corporation, and one that I've been wanting to add to right here. And I'm recording this part of the video on Sunday, July 16th. CVS is trading. It closed on Friday previously at $71.42. My average cost is $65.22. So I'm up around 9.5% right there on my investment with CVS. And I reinvest all my dividends right now is what I do. So all the dividends that I make from my companies, I reinvest them into those actual companies, because I do want to own more of those companies. Outside of these 5 that I'm talking about right here, I want to own more of my other companies that pay dividends as well. So I do dividend reinvestment just to let it kind of go. And of course, when stock prices are down, when things are kind of going rough in the economy, I try to add more to my dividend stocks. And when the company's doing well and stock prices are up, I try to buy them as well. It's a little bit harder seeing the average cost go up and seeing, the stock price being higher than my average cost and buying some. But hey, got to keep going. Dollar cost averaging. So with their dividend of CVS, their payout ratio is only 26.6%. So that is a nice payout ratio. Different people have different rules, so to speak, or, thoughts on payout ratios or what it should be underneath to be a good payout ratio. Some people say, under 40, under 50, under 30, it pretty much depends on what kind of company it is, because some companies have to have a higher payout ratio, real estate investment trusts, REITs, so some companies have to pay out more of their cash flow to shareholders via dividends. So with CVS, though, they're not like that. They don't have to pay out a certain amount or anything like that. But that payout ratio of 26% is very nice. That has room for growth. They can easily cover their dividend right here. They don't have an issue with covering their dividend. They could definitely cover that dividend right there. But their current yield, 3.24%, is a nice yield right there. Quarterly dividend is at 61 cents. And this right here on this website, TipRanks is an awesome website, and I'm going to be using it throughout the video along with a couple other websites. But they state that the dividend growth for CVS is 14 years, but that is not necessarily correct, because if you see, recently raised that, from last year from 55 cents, and then the year before that 50 cents. But then if you see here the history, it's been at 50 cents for years, and then 43 cents back in 2016. But after that, 50 cents for years. So the dividend growth over here on Seeking Alpha, they have it at 1 year. So, you just sometimes you gotta, I like to use different websites when I'm doing these videos and when I'm doing research and analysis, because some data that these companies pull isn't correct. So, you can't just really rely on one website. I don't like to do that personally. If I'm just checking real quick, I just go to like Yahoo Finance or MSN Money or, CNBC for just checking real quick, or the actual, investment platform I use. Of course, I check that, to see where the stock price is at and where the stock price is moving relative to the chart, the past year, past 3 months or something. So yeah, but and on here, right here, we got the payout ratio of 25.8%. So slight variation right there, but that's still a really great payout ratio. You got the CAGR, the compound annual growth rate of the dividend right here, 5-year at 2.92%. So yeah, not that great right there with the dividend growth, but it's a nice dividend and they can cover it so well. And the company themselves are so strong, they're solid. Let me show you the financials of CVS, because there are multiple factors why I like these companies on this list. Not all of them are just, have a really high yield or have a really great growth rate with their dividend or anything like that. When you find all that together in a company that you understand and everything, yeah, that's great. Great dividend yield, great growth rate, great balance sheet, different things like that, for sure. And I'm not saying like these are the 5 best dividend stocks right here of all time or this year or anything like that. Just for me personally. And I know some other people may be thinking the same thing with some of these companies. Like, yeah, I really like that stock as well. It's in my dividend portfolio or it's in my portfolio. I want to own more of it. I've been buying more of it. So yeah, I know there's some overlap in this right here, but right here, I want to go over to the financials of CVS, show you one of the reasons why I really like this stock. Look at their revenue growth and how massive it is. Yeah, there's some single digits, 4%, 8%. There's some double digits, 10%, 31%, 5%, 15%. So you see, but you see which direction it's going, right? It's going upwards. Very nice right there. And of course, the expense is going to go up when the revenue is going to go up. Not always. I mean, sometimes expenses come down, you get better, but look at the margins right here. Very nice margins right here. They have improved. Was 17, 16%, 19%. Now it's in the high 30s, 38%, 39%. So nice gross margin right there. And I'm really liking some of the way this company is moving with their financials. Net profits bouncing around a little bit right there. This looks crazy right here. This must have been when they bought Aetna maybe, or which year did they buy Aetna? So yeah, that was in 2018. In 2018 is when CVS pretty much acquired Aetna. So you see kind of how things look a little bit shaky around that time right there. So yeah, you had a big acquisition, a big purchase during that time. So that can throw off the numbers sometimes, but that was a smart acquisition, I believe. I believe it's paying off and it will continue to pay out, because health insurance is not going anywhere. Of course, they're not the only one that provides it. And just like CVS isn't the only, pharmaceutical retail company, but is a major part of life. It's a major part of humanity. It's a major part of, humanity in America, whatever you want to call it. Like, it's healthcare and pharmaceuticals and all that. That's not going anywhere, So, and they are major players in this. They built somewhat of a moat in this with the pharmaceutical side, the retail side, and also with the health benefits side now. So they're building a moat of healthcare on their little island themselves, kind of. And of course, like I said, they have competition. They aren't always number one in what they do, but they are massive. And we see right here, their PE ratio, little, not just, some people say, you need to have a PE under 20 to be a value stock right now. And this has bounced around a little bit, the PE ratio, but the earnings and the stock price, because if you see right here, year to date, CVS is down around 23%. So, and for the past year itself, 25%, 3 years up 9%. 5 years, around 9%. And for the lifetime since inception, of course, over 1,000% gain in the stock right here. But for this year, they're definitely down. That's why they've got on my radar more, because like I said, my average price is in the 60s, but how low they're going right here, I'm just like, kind of like, okay, it's time for me to add more. And I actually have added more CVS. Yeah, I added a little bit, a couple times in June. That one on June 14th, that was more than June 6th. I remember I was like, okay, I'm going to add even more now. And I've definitely got my eye on adding some more. It's been up in the past 5 days or so. Right here in the past month, I believe it may be up. Yeah. So it kind of got a little bit out of my under 70 where I was wanting to keep acquiring it. I was hoping it would stay under 70 more. But now it's above 70. I'm like, yeah, let me just start adding a little bit more here and there, because I really like that yield at 3.3, 3.4, percent yield right there. And they had a little insider buying recently, which I do like seeing that, because insider sell for various reasons. So when insider sells, and it's not that big of a blip on my radar, it's kind of like, oh, okay, it's interesting, because insider sell for various reasons, a new vacation home, a new car, the kids going to college, vacation themselves, who knows, various reasons. But typically insiders only buy for one or two reasons, to show confidence in the company because they know what direction is going, or to also because they think the stock itself is undervalued. So, they want to make money as well. They're like, hey, my company is undervalued, or a company I'm a part of is undervalued. I'm buying more of this because I know we're awesome. We're doing great things, or our financials are improving. We're solid. So there's only a couple of reasons why insiders buy, and they have an insider buying right here, 14,000 shares, almost $1 million in value right there. And this is from an insider. They're not on the like at the top of the list. Of course, it is nicer to see a CEO, president, CFO, something like that, vice president buying for sure. You have directors that buy as well. That's not necessarily the reason why I was like, oh yeah, I'm buying more. This one insider bought more, but it is nice to see. And also the analyst estimates for this stock are higher than where it's at for sure. And of course, not all analysts are right. Always just follow analyst estimates. They're not always going to be like, oh, the estimate is higher than what the stock price is. It's a buy automatically. That's not necessarily the case, but it is nice to see, some confirmation when you're buying a company or when it's on your radar, when the analyst estimates are higher than what it is. So on the MSN Money site, there are 28 analysts right here with the average 12 months price target of $96.18. So definitely higher than where it's at now. So that's nice. Overall, an average of a buy rating with this one. And on Tip Ranks, there is analyst forecast as well, and they have 17 ratings with an average 12-month forecast of $92. So once again, higher than where it's at. The highest price target at 109, average price target at 92, lowest price target is 76. So even the lowest price target is higher than where the stock is trading at currently right now. So that is nice for sure. And on the Tip Ranks report card of the stock right here, they've got it listed as a 10 out of 10 outperform right here because of all these great things happening with it right here. You got strong buy with the analyst estimates right there. You got blogger sentiment being bullish. You got hedge funds increasing their position in this stock by 1.2 million shares last quarter. That's awesome. You got insider transactions. That insider buying right there I was telling you about right there is almost 1 million. And they have crowd wisdom, very positive, and news sentiment is positive. And another website I like to use often is Simply Wall Street. With their snowflake analysis, they're stating that CVS is an established dividend player and good value. And they stated right here that CVS is trading at 58.1% below their estimate of its fair value, and that their earnings are forecasted to grow 19.26% per year. And yeah, that's awesome. We talked about that dividend. It pays a reliable dividend of 3.39% because reliable, because that cash flow, their payout ratio is nice. It can easily cover that dividend. They're not like struggling to pay that dividend, because when companies struggle to pay their dividend, what happens? The dividend gets cut, or the dividend gets suspended or paused. They can't keep paying out a dividend that's really nice if they can't afford to. They have to resume operations. They got to try to grow themselves or make money. If a company is growing nicely, balance sheet is nicely, they're not having an issue with paying their bills and everything, and they can pay out a nice dividend, and they're not struggling to pay out the dividend, well, how they're going to thank investors even more is by increasing that dividend steadily. Not all these companies I'm going to talk about, not everything's great. Of course, there's always risk associated with different companies usually. And CVS has a high level of debt, and they have a large one-off items impacting their financial results. And they stated their profit margins 1.2% are lower than last year at 2.7%. So a little bit, some things going on right there. But overall, there's a lot of great things going for CVS. And I really like this company as a holding in my portfolio, and definitely I plan on continue to growing it right here and adding to it. Dividend X date is going to be July 20th, 2023, with a payout date of August 1st, 2023, and a record date of July 21st, 2023. So you want to own it prior to that ex-dividend date right there and be on record. When the record date hits, you want to basically be a part of that record. You want to have the dividend company in your portfolio if you want to get to that payout date right there. So if you end up, buying the stock, if you don't have a position in the stock and you buy it on the 21st of July or the 22nd or anytime after that, you're not going to get that dividend payout on that next dividend payout, which will be August 1st for this one. You'll be on the next dividend payout basically. So it's just one of the things just to notate. Like, some people go in and out of dividend stocks or trade them with, with options to make money off the dividend and make money off the options. And there's nothing wrong with that. Hey, people do different things in different ways, more power to you. Their dividend growth rate is kind of all over the place because of how their dividend wasn't growing, but it was growing. So yeah, 1 year dividend growth rate of 10%, and then a 3 year of 4.92%, 5 year 2.92%, then a 10-year CAGR dividend growth rate of 11.54%. So you have some nice growth rates here, and you have some, so hopefully we can see that increase. That would definitely be great, because dividend growth stocks are that's a great way to go for sure. Some people invest off yield, some people invest off the growth of a dividend. I like to have a balance of both in my portfolio, some nice high yields and some nice growth. And when you hit that moment of having a nice high yield and nice growth, that's like the balance, the great way right there. So in a dividend safety, a CVS is going to be nice because the payout ratio is nice. So that dividend is safe. It doesn't look like one that's kind of shaky where it's like, oh, this dividend is going to be paused or cut, soon, because that payout ratio is too high. So that looks nice. And like I stated, the dividend history showed you that. And that's my overview right there, brief analysis, opinion of CVS Health, the stock ticker symbol CVS. Now let's go to the next company on the list, Pfizer. Pfizer is a biopharmaceutical powerhouse. This is one of the top pharmaceutical stocks for sure. If you've seen anything about pharmaceutical, medical stocks, you've definitely seen an article or something about Pfizer. Ticker symbol PFE. I'm currently down a little bit in Pfizer. My average cost is $38.59 with a negative return of 5.9%. And I recently added Pfizer to this portfolio a couple months ago. While they've been trading under 40, I've been trying to accumulate them because Pfizer treated me well before. I had Pfizer as a long-term holding in a different portfolio, and I definitely took some profits off of that for sure. I had it, bought it way before COVID, a couple years before COVID, held on to it, reinvested the dividends. And let me show you the chart, of course, of Pfizer. And so it definitely had a nice run and it came back down. So with Pfizer, ticker symbol PFE, right now, like their PE ratio, price to earnings ratio, 7.11. Very nice low PE right there. Dividend yield of 4.49%. Very nice. Quarterly dividend they're paying out per share, 41 cents per share quarterly. Very nice. And you see the payout ratio, 26.14%. Another great payout ratio. Not going to have an issue covering that right there. It's under 30. They got room to grow that dividend. They've got room to, they could pay out that dividend. I don't look at this as a dividend that's kind of shaky. I look at this as a safe dividend stock. Even though the stock price itself has been, going down lately and has been down for the year and past year or so, Pfizer is down year to date about 29%. For a whole year, down around 29%. 3 years, up about 5% right there, around that much. 5 year stock's around 2%, so not this great of a stock. Like if you, depending on where you bought it and when you sold it, of course it could be a great stock to hold, but if you just held it for 5 years, right here, you're barely up right there. The dividend's been nice, but yeah, you're still you're barely up. Like you can just have that money in the S&P 500 and you'll be doing much better for sure. But since inception of the stock, it's up over 2,000%. So, definitely if you bought, a couple decades ago, it's been great if you just held on. But, past years have been shaky, pretty rough with this stock. Definitely had that bump post-COVID with the vaccine and everything like that. Now it's kind of coming back down right now. Past few days, past week, a lot of stocks have been going up a little bit, and it's part of the stocks have been going up, not a ton. And I want to keep accumulating this under $40 and definitely around this $36 mark to bring my average cost down. As you see right, I'm going to put it up on the screen. I've been buying Pfizer multiple times throughout June and in July. So it's definitely one, like I stated, that I am working on accumulating more and more of underneath this $40 mark and definitely around this underneath 37, just bring my average cost down. So I'm accumulating here and there throughout June, July, and I will continue with this one for sure. So yeah, Pfizer, let's go over some more information on Pfizer right here. And once again, we got a difference of the dividend growth right here. So on Tip Ranks, they have a 2 years of dividend growth. So let's check out the history of this dividend, because you see right here, quarterly it was 36 cents per share. Then it was 38, went up cents per share. Special quarterly dividend right there, and then 39 cents per share, 40 cents per share, 41 cents per share. So they've been raising it for sure right here. And on Seeking Alpha, they have the dividend growth of 12 years right here. So they've raised this dividend right here for 12 years. Nice payout ratio, like I say, slightly different on different websites. 26.14%, 26.01% on this website. So a slight difference, but still a nice payout ratio in the 20s. Very nice right there. 4.52% dividend yield. Great. Their 5-year growth rate on their dividends, 5.32%. So that's their CAGR right there. And for their dividend dates, they have an ex-dividend date coming up of July 27th, 2023, with a payout date on September 5th, 2023. Record date is going to be, of course, the day after the ex-dividend date. So that's July 28th. And they declared it back in June. So you have it pretty much set up like that with dividend stocks. They declare what their dividend is going to be, whether it's going to be the same, whether it's going to raise or everything. And then a month or so later, around that much usually, is the ex-dividend date, the record date. And then a month or two, roughly around that much, is going to be the payout date. So you pretty much see almost the same time span when it comes to dividend stocks that are pay out quarterly. Of course, you have some dividend stocks that pay out annually or semi-annually. And on my list right here, most of the stocks pay out quarterly, and I have one on the list that pays out monthly. And the dividend growth rate with this one is a little bit all over the place. 1 year, 2.55%. And then we have a 3-year CAGR growth rate of 4.94%, 5-year of 5.32%, 10-year of 6.40%. So this one, like I say, it's got a growing dividend, but it's not really high growth in a dividend right there, but that yield is very nice right there. So yeah, it doesn't have a ton of growth in the dividend section right there, no double digit CAGR or anything like that, but it has a nice yield above 4%, very nice yield right there, and the safety of that yield is going to be great. And let's take a look at some of the financials for Pfizer right here, because they generate a lot of revenue. And look at this growth right here, because you have 40 billion there, 52 billion there, 41 billion there, and then that vaccine with COVID jumped it up. You see that 95%. They went from $41 billion to $81 billion in 2020 to 2021. And then in 2022, $100 billion right here, 23% growth year over year with their revenue right there. Look, and then gross profit, 33 billion, 50 billion, 65 billion. That's the thing with pharmaceutical companies. You can have those standout years, because it takes a while to bring a drug to market. You got research and development, you got the FDA approval with the trials and all that. So, and then sometimes it doesn't go the right direction. It'll fail a trial or something to go wrong with the drug, or, adverse effects. And then all that money, not going to say wasted, because you can learn from that, of course. But, and that's a miss right there. That can bring the stock price down, slow down revenue growth and things like that. But you have a breakout drug, breakout medicine, vaccine or something like that, and that can really take off with the revenue, really take off with your profits. So pharmaceutical companies, that's how it goes with that. A lot of money spent on research and development. Some companies in pharmaceutical space do acquisitions to grow, and Pfizer is definitely part of that. They've been acquiring as well, and that costs a lot of money as well. Sometimes you see that on the other end though, as far as like increasing their profits. And right here, gross margins, very nice gross margins right here. They've gone down a little bit, but they're still nice. Just 79%, 80%, 79%, 62%, 65%. Very nice gross margins right there. So a lot about the financials with Pfizer that I like right here. Total assets higher than total liabilities by a lot, and that's been going on for years with Pfizer. So yeah, that is awesome. I definitely like saying that. I like the financials of Pfizer. It's definitely, like I said, one of the largest, biggest pharmaceutical companies in the world right here. What is the market cap of this? $205 billion market cap. That is a major company right there for sure. The thing that's going to be a risk with them is the total debt. They have a lot of debt right there. They got a lot of cash, but they got a lot of debt. They generate a lot of revenue though. So I like to see that. If you got a lot of debt and you don't generate a lot of revenue, a lot of profits, and that's definitely an issue. But so that's something that's a red flag to look at, is like the debt. I don't like when the companies have a lot of debt, because debt can be expensive. But one thing I do like is that with companies that generate a lot of profit and a lot of cash flow, because you look at Pfizer's cash flow, let's go over here, free cash flow right here, and they generate double-digit $1 billion of cash flow. So yeah, 20 billion, 26 billion, 29 billion, 12 billion. So yeah, they generate a lot of cash flow right there. So yeah, the debt is a concern. Cash flow is nice, can definitely increase. Like I say, one or two good drugs, good trials, something happens like that, another vaccine, there's acquisition that goes well, and boom, revenue increases, cash flow increases. Analysts right here on MSN Money, they have 26 analysts with an average of a buy rating right here, 12-month price target of $46.39. So that is higher than what it's at right now. Nice analyst expectations on that one. Let's go over to Tip Ranks. With their analyst forecast, they have 17 ratings right here with a 12-month price target of $46.60, so 28% upside right here from the current stock price, and the highest price target of $75. Average, of course, going to be at $46.60, and then the lowest price target of $35. So the lowest price target is a little bit less than what it's currently trading at, but you see that's a nice average price target, 28% upside. And let's go over here to Simply Wall Street. What they're stating right here with their snowflake analysis is that Pfizer is undervalued with solid track record and pays a dividend. And on this website, they state that Pfizer is trading at 55.3% below their estimates of its fair value. Its earnings grew by 14.4% over the past year, pays a reliable dividend of 4.52%, and trading at a good value compared to its peers in the industry. So those are nice all around. Look at that graph right there, 5 out of 6 check marks, nice dividend value, health of the company, strong financial health, strong past right there. And the risk on this one, it states that earnings are forecast to decline by an average of 9.6% per year for the next 3 years. There's various things that can affect their earnings and things like that for sure, but that's what they state is the risk with this one. Very nice rewards compared to the risk with Pfizer right here per Simply Wall Street on their website. And like I've been noticing with my research and everything I've read about them and their financials and everything. And this is, like I said, it is a stock that I want to accumulate more of. You saw it on the screen. I have been, like, for sure, and I want to continue. So I like that dividend for sure with this one. And also, let's go over to the insiders. There's been an insider buying right here. We have independent director right here that recently bought on May 4th, 2,000 shares. So that's about $77,000 in value. You have somebody that sold back in March when it was $40 per share. This recent insider bought at $38.58 per share. And on the report card for Pfizer right here, you have a 7 out of 10. So they have a moderate buy with the analyst forecast right there. They have bullish with the blogger sentiment. And hedge funds, they have them decreasing right there. So they've decreased by 3.2 million shares last quarter. So that's something like, oh, okay. They have insider buying with that transaction I just told you about. They have crowd wisdom at positive, new sentiment at neutral. So yeah, there's a lot of course, institutions in Pfizer that own Pfizer, but there was like a slight decline from the fourth quarter of 2022 to the first quarter of 2023, but it's still higher than the previous first quarter. So it's not anything that's like too standing out to me right there, but you can see the top buyers who've increased their position: Charles Schwab, Vanguard, Franklin Templeton. You can see the top sellers: Barclays, JP Morgan, you can see the percentages. So it is interesting. It's definitely something to look at, top holders and what they've been doing with their positions in this stock. BlackRock, State Street, Vanguard. It is definitely interesting to see what institutions are doing with their holdings and stocks, and something to add to researching stocks for sure that I like to look at. All right, so yep, that is Pfizer on my list. Definitely a dividend stock that I've been increasing my position in and plan on continue to. Nice yield, nice balance sheet, just a pharmaceutical giant for sure right there, Pfizer. Ticker symbol PFE. And the next company in stock on my list right here of my favorite dividend stocks that I've been buying recently is Target, ticker symbol TGT. And you've seen Target, you've seen the logo. I mean, brand. Like, one thing screams with Target is brand value. Brand value, yes. And I actually made a short video recently about 5 reasons why I've been buying more Target stock. And that's part of it. That was one of the reasons. It's brand value. And it was about the intrinsic value. It's trading below its intrinsic value right now. You get different calculations for intrinsic value. So the medium baseline intrinsic value for Target was around $150 something, and there's a best case scenario was above $200, and then the worst case scenario was, like, I believe where it's trading now, or lower, like $120 something. So yeah, just throwing it out there, and like definitely check out that video. This was the shortest video, but this is going to be definitely more detailed right here when I talk about Target, because yeah, Target is the 6th largest retailer in the United States based on retail sales, in the billions, of course, and that was last year in 2022. Target $107.59 billion of sales. And you see the list right here. You've seen actually right there below them, CVS, which is another stock company that was on my list right here of the dividend stocks. And so number 1, you got Walmart, you got Amazon right there, Costco at 3, Kroger at 4, Home Depot at 5. Another nice dividend stock for sure is Home Depot. They almost made this list, and I was like, but that's I haven't been buying them. So that's the thing, like, with this list is about dividend stocks that I've been buying. So that's like kind of an exception. Not the best dividend stocks of all time, not the best dividend stocks of this year that are down the most this year, best value this year. It's dividend stocks that have down this year, or around my average cost price, that I've been buying basically recently, or want to buy more of. So yeah, but yeah, number 6 right here is Target, and you got 7 CVS, 8 Walgreens, 9 Lowe's, 10 Albertsons companies, and then on and on and on with the list. So yes, and Target has recently rose. I believe not that long ago they were like number 8 on this list. So they've been rising up. Target's just been growing. And yeah, they've taken a hit recently. Let's look at their current stock price. Like I said, they've been down, trading around this $130, $132 or whatever a share for about the past like month or so right here a little bit. You see them, they're just in the 130s hanging out, and they've definitely taken a hit. And year to date, Target is down around 12%. For a whole year in general, about the same, right there from last year, about 12%. 3-year up about 7%. 5-year up 68%, and max from the lifetime of the inception of the stock up over 4,000%. They've had a rough year, Target, and the stock price of Target's had a rough year for sure. They had some inventory issues going on with COVID that kind of prolonged, kind of hit them. They finally kind of got that in order, but then earlier this year they had some things going on with the social part of the Target. Like, how some brands, like, they'll just do great at what they do, but then they'll introduce something in their lineup or something about their stores that's kind of controversial that splits people in half, or splits people 60-40 or 25-75. There's no way. That's why it's kind of weird to me when companies get involved in something that's gonna like split their consumer base. It's like, you're great at what you do, and then you want to do this other thing. Like, not everybody's gonna agree with your stance on this and that. But I won't get into that, because and I'm not gonna. That's not the reason why I'm buying this. I'm not buying it in supporting of this or buying it against supporting of that or whatever like that. I'm buying more of Target stock because I like the stock itself, the company, the other things besides the social things it's doing or whatever. So and some of the social things they do, I do like. I agree with. I'm like, sustainability, things like that for sure. So I'm not going to get into all that. But anyway, so yeah, I'm buying it because I like the dividend. I like the growth of this company. I like the actual store itself, the financials. Yeah, like I said, it's been a little shaky. We're going to get into that for sure. And with Target and their dividend, Target is a dividend king. Okay, so dividend kings are companies that have increased their dividends consecutively for at least 50 years. And then you have dividend aristocrats, which is at least 25 years. And Target is a dividend king and has been for a couple of years. They've increased their dividend right here. 54 years of dividend growth is what is on Seeking Alpha. And I believe I saw it around a little bit more than that some elsewhere. Let me see, another website, 56 years on this website right here on dividend stocks. So yeah, definitely above 50 years. Like Target has been increasing their dividend for over 50 years. They've hit that 50-year mark right here, and this is incorrect on tip ranks right here. It says dividend growth 14 years, but Target is a dividend king, and that's another reason why I really like them, despite what's going on in the economy and what's going on with their company, you know, in the world. You know, macroeconomics has been affecting the stock price, and you've seen the stock price, you know, kind of jump all around the place and everything. But what stayed consecutively during the down times and the up times and all this back and forth right here is the dividend. It's been solid, and they've been paying it, and they've been increasing it. Now let's go some other information about Target for sure. And like, that's one thing that shows strength and resilience. If they're dedicated to paying back shareholders that dividend, no matter what's going on with the stock price and things that happen with inventory. They could have easily made their financials look better by, you know, cutting back on that dividend, not increasing it or pausing it or something like that, but they did not do that. So that shows strength right there and dedication to paying back the shareholders right there, the investors. And so yeah, Target right here on the Simply Wall Street Snowflake Analysis stated they're an undervalued average dividend payer. And so they're, you know, seeing right here 5 out of 6 checks on the valuation because they are trading, their stock has been beaten down right here. According to this website right here, they're trading at 51.1% below their estimate of its fair value. And they also state the earnings are forecast to grow 15.35% per year. And the analysts in general are in good agreement that the stock price will rise by 31.9%. And we'll look at the analyst estimates here. Now, of course, there's some risk going on with this. Has a high level of debt. The dividend they state of 3.38% is not well covered. And they state the profit margins are lower than last year, or profit margins of 2.5%, lower than last year at 5.5%. So let's look at this payout ratio for the dividend right here. So according to tip ranks, they got a payout ratio of 73.59%, which is definitely on the higher end, something I don't like to see above, you know, 40%, 50%. It starts to get kind of like, if you're not like a certain kind of company that has a payout, you know, a bunch of dividends. So that is, oh yeah, we're going to talk about that. I kind of slipped in one of the things I'm going to talk about. You saw it on the screen, but Seeking Alpha has a payout ratio of 70.53%. So that is concerning. That's, you know, showing, like I said, they've been having some issues with their financials, not in the sense of like, oh, bankruptcy or anything, you know, like wild like that or anything, but they are paying out more of their cash flow to dividends. Basically, like, you want that payout ratio to be lower to show that you can keep increasing it and more safety, like if the dividend not getting cut or paused. Like I know Target and the executives there would hate to lose that dividend king status, but maybe they won't increase it as much as they normally would have if they weren't having such a huge payout ratio, if they weren't having to pay out so much, you know, instead of having that higher dividend growth. It may be a little bit set back, so they can still increase it, still keep that status up, but not be as much as they want to. Right here, their 5-year dividend growth rate is 11.74%. So that is really nice right there. And let's go over some more dividend information about their growth rate. So let's see here. 3-year dividend growth rate, 17.84%. That 5-year, 11.74%. And a dividend growth rate CAGR 10-year is at 11.61%. So they have a double-digit CAGR for the dividend growth rate for the 3-year, 5-year, and 10-year. Very impressive right there. Definitely like to see that dividend growth rate that high right there. Double digits is great. High single digits, great. I mean, as long as you got some kind of dividend growth, is great, of course. But of course, the higher the dividend growth rate, you know, that's awesome, you know. So yeah, they have a nice dividend growth rate right there. You got a good score on that. And like I say, the dividend safety is a part that's kind of like a, you know, because of that, how much they're paying out right here. And so you'll see there's different ways of seeing this payout ratio right here. So if you see the dividend, the cash dividend payout ratio, crazy right there, 384%. And you have the dividend payout ratio calculated with GAAP is 73.59% right there. So you see that. And if you have the cash flow payout ratio right there, it's 26.11%. So there's different ways of looking at the payout ratio. Some of them are like concerning, some of them is like, but overall, would be nice definitely if they can get this down right here. Like you see, the sector median is lower than their payout ratio for the sector of, you know, retail. And Target's annual dividend is $4.40 with a dividend yield of 3.38%. So a quarterly dividend of $1.10 per share. So their next dividend date is going to be August 15th of 2023 with a record date of August 16th and the payout date on September 10th. They declared this dividend back on June 15th. And so, yes, let's take a look at those financials because I've been talking about them, and let's look at them right here because one thing for sure with Target, they make a lot of money. I mean, you see they're number 6 on the list for the, you know, biggest retailers in the United States. So you see the growth right here for sure. Like they had some single digit moments for sure, you know, prior than COVID right here, 2020, double digits started to happen a little bit, and now they're back to the single digits for this past year right here. But they see that growth still: 70 billion, 72 billion, 75 billion, 78 billion, and 93 billion, 106 billion. And of course, their cost of goods have rose as well with that. And the gross profit is the one that's kind of bouncing around right here. That's where they take a hit right here recently. You see that negative gross profit right there. That's definitely not good. Negative, and not negative in general, like the gross profit is negative, but the year-over-year growth was negative. And then the year-over-year growth for the operating income, those are issues that's going on with Target right there. Negative growth year-over-year with the net profit. And so, yeah, it was going up nicely. All these numbers going up nicely. And this past year right here, it's been a rough mark for Target for sure. You see these numbers right here, and it's negative year-over-year growth, and it's reflected in the stock price, along with, like I stated, with those other issues that they're going through. But these moments like this right here can create opportunity for investors if they like other things about the stock. If they, believe that the intrinsic value is higher than where their stock's at. If the value of the stock, if it's undervalued, or they see a company's going to turn this around. I believe like Target's going to turn this around. I would be very surprised if they just kept going in this direction of negative, year-over-year growth, negative, and the earnings were started going down, the revenue started to go down, and, just, things like that. I would be surprised. Like I say, it's not impossible, of course, and this isn't financial advice, but I just don't think from the other things from Target, they've been resilient. Like I say, they've done things over the past decades that have showed strength, and they adapt and they do different things. They push the online sales more. They change the way their stores are mapped. They've updated stores. So they've done things to adapt and to grow, not just sit there and say, oh, we're going to do the same thing and you're going to like it. No, they've done things for sure to go along with the times, become more mobile and things like that. So, and one thing I do like right here, the gross margin is in 20-something%. It's been hanging around there. It's gone down as well. Like I said, this past year, definitely rough. They had the 29% just hanging out for years right here, and then it went down a little bit right there. So definitely some room for improvement in different areas with Target for sure. But the financials, like I say, they are a behemoth in making money, generating money. This past year, been a little rough with the gross profit and the costs right there, so associated. So they still got some things to definitely work on and fix in their company. Like I say, reflected in the stock price. But I've been looking at this as an opportunity. Let me tell you about, my current position in Target. And as much as I like Target and as much as I've been buying the stock lately, they are the worst performing stock in my portfolio that I have them in. So yeah, I'm currently down around 26% in this company. My average cost is $178 when I took this screenshot. So yeah, as you see, I've been buying Target throughout June. And I just started again throughout July on Monday, the July 17th. And I started buying more because it was underneath $130 per share, and I just, for some reason, that just gets to me, and I'm just like, I'm going to buy more. Yeah, it can go down for sure. It gets, like I say, it's been hanging out, and it's 130. It's trying to show like a baseline or a path of resistance somewhat in this 130 area right here, and it's trading, of course, below its 200-day and 50-day moving average. But it seems like it's kind of making a resistance mark right here. So when it gets around this area, I've just been accumulating. I'll throw like $50 at it, $100 at it, $20 at it, something. It's the worst performer in my portfolio right now, but eventually it may be one of the best performers in my portfolio, and I'm just going to let that dividend keep reinvesting in Target for sure. But so that is a rough part. But let's look at the analyst estimates for this right here, because let's see, on MSN Money, they have 36 analyst estimates right here, and the target price 12-month is $171.44, and the average recommendation is to buy for this right here. So analysts are on board with saying that the stock price is undervalued right here. And also, let's go over to Tip Ranks. Tip Ranks analyst forecast, they have 25 ratings right here with an average 12-month forecast of $175.90, highest price target of $220, and the lowest price target of $130. So it's trading right around that lowest amount right here of that. So 25 analysts right there on that. And on Tipwreck's report card, it's getting a 6 out of 10 right here. Analyst consensus is a moderate buy. Blogger sentiment is bullish. Hedge funds have decreased their holdings in Target right here, about 236,000 shares right here. So not in the millions, but still an amount that's, on the decline and not on the incline. And then you have insider transactions. You have insiders that sold about $234,000 worth right there in the past 3 months. Crowd wisdom is positive, and news sentiment is very, very positive. So some definitely things going in the way, favor of Target. I'm sure people are seeing this stock being beat down and going like, there's no way it's staying down this long for this, or maybe it will stay down this long for the rest of the year, next month or so, but they're just thinking like, there's no way this is a long-term thing. And for all of these stocks I'm talking about in this video, including Target for sure, all of these are long-term holdings for me. I'm not planning on like trying to sell these in a few months, like, oh, these are going to go up by the end of the year, I'm going to get out or something like that. These are all long-term holdings that I'm trying to add to and let the dividend reinvest into them as well. And then before we move on to the next stock right here, one thing I do want to notate about Target, and I mentioned this in that shorts video, is that one thing I really like about Target and how they're growing and how they position positioned their company, the things they're doing inside their company, are their own private label brands. They have 10 private label brands that have generated over $1 billion in sales. And according to Fast Company, they have launched 48 private label brands or owned brands, however you want to call them. And yet of those, 10 of them have surpassed 1 billion in sales. And actually 4 of those have generated over 2 billion in sales per year. So you got the Cat and Jack brand, the kids apparel, Good and Gather food brand, Up and Up household and Threshold home decor. Major brands. And these are in-house brands that they pretty much created almost pretty much from the ground up. You know, they control a lot of factors of these brands. And so you know what that means, great margins. So yeah, when you can control various things of things that you sell, you can cut costs in so many ways. And some of these brands have grown so fast with Target. For example, in 2020, Target launched a brand called All in Motion, which is a line of activewear and accessories, and they've already passed $1 billion in sales. And that's, you know, a couple years ago right there. So yeah, that is fast right there. And they state right here, Target has an astonishing $10 billion brands it built itself on its roster, something only a few other companies like Procter & Gamble can boast. So not many companies can say like, hey, I've launched these many brands and they've hit this sales mark. Yeah, you may sell some millions, or you may launch some brands and they barely did anything or something, but that's a very impressive stat right there. Very impressive with Target with those $1 billion brands. So that's something I wanted to mention. I talked about it in the shorts video briefly, but it's one thing I really like about Target that shows strength in their company and their brand and how they can create value with their brand, and also shows like future, you know, what they're capable of doing basically. So it's really interesting to see that. And with the dividend stability of Target, according to the Dividend Stocks website, they give it a 0.97 out of the max of 1. So very solid, stable dividend according to Dividend Stocks website. So yeah, that is Target on the list, ticker symbol TGT. And next on the list is Realty Income, ticker symbol O, which is also known as the monthly dividend company right here. This is a major company right here in the dividend community, the dividend crowd. If you have somebody that really likes dividends, has a dividend portfolio, there's a high likely chance they either have Realty Income in their portfolio, have had them in their portfolio, want them in their portfolio, or at least know about them for sure. All right, and Realty Income, my investment basically, I'm only up about 2.44% right here, and my average cost in the company is $59.34. I just recently started adding this company to my portfolio this year, and I've been adding it a lot. As you see right there, throughout June and through July, I've been buying Realty Income around that $60 mark, and definitely when it's under $60, that's how my average cost is under $60. I've been buying most of the time when it's under $60. I really like that price point right there, around that $60 amount and below $60. As you'll see right here, this company, let's go to the chart here for Realty Income. So Realty Income is down this year to date, around 4%. For a whole year in general, they're down 12%. And for 3 years, they're up around 3%, almost 4% right there. For 5 years, they're up 10.58%, and max lifetime since inception is up 632%. So this one, like I said, this past year has been rough for sure with Realty Income, with a 52-week high of $75.11 and a 52-week low of $55.50. So it's trading on that lower end right there is where it's been at. It's kind of been like you can see for the past 3 months where it's just pretty much been hanging out in the 60s. And a lot of this year, just on the lower end of the 60s for sure, bouncing down at below 60, bouncing up, bouncing below 60, bouncing up. So yeah, I really like to catch it right here when it's right around 60 or below 60 for sure. And like you saw right there on my buys right there, I've been buying it for sure. And Realty Income is a REIT, a real estate investment trust, and they pay out monthly. So that has been awesome. You get that dividend rolling in every month, and I just reinvest it into more Realty Income. And they have a diversified portfolio. So they're not just relying on one section of type of buildings or a type of, a sector or anything like that. Like, oh, if retail, really takes a hit and they're not able to pay their bills or something, like they're in dire trouble. Yeah, that would definitely hurt for sure. If a lot of retailers could not pay, their bills, basically could not pay for their buildings and everything, that would definitely hit. But like they have other parts of their portfolio. So they have over 12,400 commercial properties under long-term net lease agreements, a 99% portfolio occupancy. So they don't have a lot of empty buildings, empty spots that aren't being occupied. 99% occupancy rate right there. So that is awesome right there. Over 1,259 different clients in 84 separate industries. That's what I mean right there. Very diversified, 84 separate industries. Yes. And you see their geographic diversification in the United States mostly. Got some going on in Spain right there, Italy, and the UK. And according to Simply Wall Street with the Snowflake analysis, they are a 6-star dividend player with a solid track record. And they state that they're trading at 32.1% below their estimate of its fair value. And the earnings are forecast to grow 7.32% per year. And that the earnings grew by 93.4% over the past year. And that it pays a high and reliable dividend of 5%. The risk for this one state that the interest payments are not well covered by earnings, and they stated that the shareholders have been diluted in the past year. So they must have issued some new shares, which does dilute the value of the shares you own. And so for a simple example, let's say a company has 100 shares and you own 10 of them. So that would mean you own 10% of that company. And so let's say they issue 20 more shares. So now the company has 120 shares, but you own 10 shares. So now instead of having 10% of the company, you only own around 8% of the company, but you didn't do anything. So your shares, are worth less like now basically because there's 20 more shares available right there. So you see how that works with diluting shareholders. That's basically what that means in a very simple, basic sense. Of course, it's not usually that many amount of shares that they're, issuing or that they have in general. This is in the millions, thousands, all that, So yeah, for sure. So that's just basically how shareholders can be diluted. When companies issue more shares, you want to see that kind of going down the other way. When companies buy back shares, that's kind of the reverse. When companies buy back shares, now there's less shares available on the market, so your shares are worth more and you would own more percent of the company. So yeah, so that's been a risk right there for Realty Income. With Realty Income, their payout ratio is around 73.50%, on the higher end because they are a REIT. So REITs typically pay out a large chunk of their cash flow, and their dividend yield is currently at 5%. With an annual payout of $3.07, and they pay monthly. So that's going to be about 26 cents per share every month that they're paying out right there. And they have a 5-year growth rate of 3.74%. Dividend growth of 2 years is stating right here. Not a company that increases their dividend often or by a lot. I mean, they do pay out monthly. They pay out a large amount of their, money they make monthly right there. So it is a steady, solid dividend for sure right here. Like I say, this is a dividend company that is in a lot of portfolios, not just, of course, retail investors, but institutional. And I'll go over that as well. And with Realty Income, the ex-dividend date upcoming is July 31st, 2023, with the record date of August 1st and the payout date of August 15th. And they declared this dividend on July 11th of 2023. And like I say, this dividend frequency is monthly. So this will go on the next month and the next month if, things keep going well with the company and everything. Dividend growth rate trailing 12 months, 4.29% for Realty Income. You got the CAGR 3-year at 24.15%. The CAGR is 5-year at 3.74%, and the CAGR dividend growth to 10-year at 4.56%. So, and, like I said, that's on the lower end. You've definitely seen, like what I just talked about, Target, had a double digits on the CAGR right there for their dividend growth. So you do have various companies that go on different spectrums of that for sure. But you have a monthly dividend payer like this paying out that much in dividends, it's going to be rare to have a really high CAGR. I'm sure there are some out there. And the dividend safety, it's going to be, they give it a great C right there because of that payout ratio. Trailing 12 month right here, cash dividend payout ratio, they have it at 67.31%. And then you have it with the gap right there. And so, like I said, and you see the sector right there, how you have those high payout ratios in this sector of the REITs, of retail right there investments. You do have a higher payout ratio in general. And then let's look at some of the financials with Realty Income. And you see this growth right here. This is nice. High single digit and double digit growth right here, year over year with their revenue at $1 billion, 1.1 billion, 1.2 billion, 1.3 billion, 1.4 billion, 1.6 billion, over 2 billion, over 3 billion. Nice growth right there, year over year. Gross profit, you see that nice growth right there, double digits, year over year growth. And you see the gross margins right there. Excellent gross margins right there in the 90%, just straight across, 94, 95, 93%. Nice gross margins right there. And so you have a slight increase in institutional investors in this past quarter right here of 0.92% for the first quarter of 2023. You see the increase right there, just going steadily up right here. And I see the top shareholders in this company: institutional, Vanguard, BlackRock, State Street, the behemoths, Bank of America, Morgan Stanley, JP Morgan Chase, Invesco. So yeah, and top buyers recently: Vanguard, Cohen and Steers, Bank of America, Invesco, JP Morgan, and top sellers, of course, you have some institutional selling. Yeah, Morgan Stanley selling some, State Street selling some, First Trust, Deutsche Bank, and UBS. Yeah, various, of course, that's going to happen. New shareholders entering the fray, shareholders exiting the fray. Those are some of the top institutional shareholders right there. You see that nice incline with that. Let's look at the analyst expectations for Realty Income. And on MSN Money right here, you got 17 analysts with an average 12 months price target of $70.16, with an average buy recommendation right there: 4 strong buys, 4 buys, and 9 holds. So Tip Ranks only has 4 ratings for Realty Income, ticker symbol O, and their 12-month forecast price target is at $71.81, with the highest price target of $74 and a lowest price target of $68. So definitely higher than where it's at now, both on the low end and the high end. And Tip Ranks report card pretty much for this is a 7 out of 10 for Realty Income, with a strong buy with analyst consensus, bullish blogger sentiment, hedge funds increasing, talked about that, crowd wisdom positive, news sentiment neutral. You don't have a lot of news for Realty Income sometimes. Just, I mean, you see the recent news, press release, and of course they'll get on the article about dividend stocks and things like that. Safe company when it comes to news. Rarely have I seen any like controversial articles about Realty Income, something that'll stir up the stock price. I mean, like I say, if it went lower for some article, something going on that wasn't really detrimental to the company, oh yeah, I'll be buying more for sure. And yeah, with the company themselves being a pretty solid, steady company, like I was stating, the dividend itself is also solid as well. According to dividend stocks, they give it a dividend stability score of 0.99 out of 1. So, 0.01 off from the max right there. Very nice. All right. So yeah, that is Realty Income, ticker symbol O. Currently in my position, like I say, slightly up, but I'm just adding to it, and let the dividends reinvest into it. And when it's around that $60 mark, like where it's at now, adding to it underneath 60, I'm going to add to it. Even if it goes up, a few dollars here and there, this is one, like I say, I want to keep building onto for sure, for the dividend, for the nice growth. So yeah, that's Realty Income, ticker symbol O. Mentions right here for my top dividend stocks that I've been buying or want to buy more of lately is Bank of America. They've recently actually reported earnings and they beat analyst expectations. So yeah, that's definitely been nice for them right there. Surges on interest income, surprise investment and banking gain right there for Bank of America. But they're dividend paying companies and I like the dividend they pay, and let's talk about that some more right here. And now the snowflake analysis for Simply Wall Street for Bank of America, ticker symbol BAC, states a flawless balance sheet, established dividend payer. They're trading at 31.5% below their estimate of their fair value, pays a reliable dividend of 2.99%. Risk is stating that the earnings are forecast to decline by an average of 0.9% per year for the next 3 years. Now let's go over to the Seeking Alpha right here with the dividend for Bank of America. Like I stated, 2.99% yield right there. Annual payout of 88 cents per share, which is a quarterly payout of 22 cents per share. And Bank of America actually recently announced an increase to their dividend from 22 cents per share quarterly to 24 cents per share beginning in the third quarter of 2023. And they announced this a few days after the Federal Reserve stress test. And that stress test is what they do to banks to see if they could survive, an economic collapse by different scenarios like that. And I made a video recently on the major bank stocks that increased a dividend, that announced an increase to their dividend after the Fed stress test. So definitely check that out. I'll link it in the description. And Bank of America was one of those stocks for sure. Citigroup was as well, JP Morgan Chase, and a few others in that top 10 largest banks by total assets in the United States. And so yeah, that's going to add to their dividend growth from that 22 cents per share to 24 cents per share. The payout ratio is 26.13%. Very nice right there. 5-year growth rate for the dividend, 12.89%, and dividend growth for 9 years right here. Very nice right there. And let's go over to the dividend growth for Bank of America. So check this out right here. 3-year CAGR right there, dividend growth 6.92%, a 5-year at 12.89%, 10-year at 36.22%. Nice dividend growth right here for Bank of America. And like I said, I like that payout ratio for sure. In my portfolio, my average cost for Bank of America is $26.34. So I'm up around 10.54% right there with my position in Bank of America. It's one that I was hoping it would come down more, but it just hasn't been coming down enough like to my, average cost. I like buying around and below my average cost when the market's down, but it's been surging a little bit here. It's been bouncing around a little bit. Let's check out the chart. And so yeah, year to date with Bank of America is down around 7%. For a whole year, down almost 5%. 3 years up 32%, 5-year down around 1.30%, and lifetime of the stock right here is up around 843%. 25 analysts on MSN Money give it an average price target of 12 months for $34.71. Average recommendation of buy, you got 6 strong buys, 7 buys, 10 holds, and 2 sells. And the analyst forecast on the Tip Ranks website for Bank of America, you got 13 ratings with the average 12-month price target of $33.79, which is around a 10% upside to where the stock is at currently. The highest price target on the list is at $42, and the lowest price target is at $28. See the revenue, it's pretty much staying in line, single-digit growth here, got down 1 year right there. around there, 0.89%. So not a high growing kind of stock, more of like kind of like the, like I say, like a boring stocks. I guess you got to say banking. And some people are avoiding bank stocks right now because of the interest rates, and also that the Fed may require banks to have a higher amount of capital they're holding and things like that. So there's definitely some reasons to people are kind of like, not really looking at towards banks as far as like increasing their investments in them or investing in them in general. And with the institutional investors in Bank of America, the last quarter, they've decreased their holdings by 4.54%. So that is going down for sure. Not something you like to see. Still a ton of institutional investors in this company right here with the holdings. Look at that, like over $5 billion worth. So yeah, if you look at the institutional investing in several different companies, you'll definitely notice that this is on the higher end as far as like how much institutions hold of Bank of America for sure. And institution that raised their position in them, Berkshire Hathaway. Yes, Warren Buffett's company right here. They did a little bit of raising in this company right here. It's like their second largest holding in their portfolio. Yeah, look at the shares held of Bank of America. It's massive right there. So let's see who else did some buying recently, in the past a little bit here and there. You got, of course, Berkshire Hathaway. You got Harris Associates, Deutsche Bank, Vanguard Group. I'm not sure how to pronounce that one. I haven't seen that before. Susquehanna, that company right there. The increase of shares right there, Bank of America. So yeah, got some other companies here. Let's see who's been the top sellers here lately. Got a few companies here. State Street stands out. Clearbridge Investments, Fidelity Investments, slight decrease. And it's also good to see how much they decreased by. So you see them on the, top sellers, but the percentages and the amount, some of them, of course, more than others right there. So it's definitely something to look at. Let's look at the new shareholders in Bank of America institutions. And so here are the new institutions in Bank of America right here. All right, and now let's see who's exited. And I've seen Bank of Montreal on several different companies when it comes to institutions that have exited right there. So I'm not sure exactly what's going on really with Bank of Montreal, but yeah, I've noticed that a few times right there. So yeah, that is the institutional investors in Bank of America and what they've been doing lately with the stock. And the PE ratio, Bank of America right here on the Market Beat website showing 9.3%. And then on MSN Money had that PE ratio of 8.46% right here. So trading around a 9 PE ratio, price to earnings ratio. Typically with banks, you want to pay closer attention to the PB ratio, price to book ratio, instead of the PE ratio, price to earnings ratio. Still can look at that for sure and put that in your analysis. But with the PB ratio, price to book ratio for Bank of America, it is currently at 1.01. So that book value is at $30.51 per share. So it's trading right around that book value right there. So just the assets on their books right there, what that would be if that was it for the company, is trading right around that right there. So sometimes you can catch banks underneath their book value, underneath that one, which sometimes screams that, hey, that's the value. Because, some people look at the PE ratio, price to earnings ratio, to determine if a stock is a value stock or if it's trading undervalued or something like that. And with banks, you can look at that with the PB ratio. If it's trading under 1, sometimes that kind of tells you, kind of hints at you, shows you that, hey, this may be undervalued right here. So it's trading right around that book value. And another company that almost made this list of my top 5 dividend stocks I've been wanting to accumulate more of and have been accumulating more of is actually Citigroup, which is, I do hold Citigroup in this portfolio along with Bank of America. I like having at least a couple banks in my portfolios for sure, especially a dividend portfolio or, portfolio that has dividend stocks like this one that I have right here. And the PB ratio for Citigroup is at 0.50. So, its book value is $94.40 per share. And it's currently trading at like $47.04. So Citigroup is actually showing that it's undervalued and trading at a value compared to its PB ratio, its price to book ratio. And it has its PE ratio of 7.45% right there. And this is one that I almost said, like, almost got on the list instead of Bank of America. I like Bank of America overall better than Citigroup. I do hold way more of it than I do of Citigroup. I recently started adding Citigroup to this portfolio this year, and I definitely want to increase it. As you see right there, nice dividend yield, 4.34%, dividend payout ratio around 32% right there. They don't have as much growth with their dividend, but Citigroup has got to go through some things. They got affected and hit harder, it seems, from that 2008 recession that Bank of America did. Of course, a lot of companies got hit by that. Bank of America got hit by it as well, but other banks recovered from that and went on to grow and just recovered better from that. Citigroup, didn't recover as well from that other banks did, like JP Morgan and Bank of America. So it's been going through some things right there. Recently, changed the CEO a couple years ago. So they're kind of in that turnaround process. They're closing out some units, closing out some divisions. They're trying to do certain areas, certain regions of the world. So that is just one that I'm almost, like I say, almost made the list, but I didn't want to mention it on the list because I do hold it and I do want to buy more of it. And it does pay a nice dividend right there, nice yield. So it got different things going for it right here. I think it's kind of undervalued right there. It is a company, actually, Warren Buffett has been adding Citigroup to his portfolio, not nearly as much as Bank of America as the holdings, but it is one that's in his portfolio as well, Berkshire Hathaway. But yeah, back to Bank of America here. And another thing I like about Bank of America is the balance sheet. They're consistently having more assets than liabilities. So I definitely like seeing that with companies. I want to see more assets than liabilities, so that debt to assets right there is favoring, the assets. There's not more debt than assets. So I do like that, even though it's kind of close sometimes, right there. It's going to be ranging up, they're ranging going down right there. So that's nice. But it is overall more assets than debt, more assets than liabilities. So I do like that on the balance sheet right there of Bank of America. And so, yeah, that's rounding out my list right there. Bank of America, the second largest bank in the United States based on total assets, market cap right there of around $234 billion, and the largest bank in the U.S. by total assets is JP Morgan Chase with a market cap of $449 billion. So like I mentioned, that is definitely a big difference right there, almost half the size right there. And I do like JP Morgan Chase. This stock, ticker symbol JPM. I have held them in a previous portfolio before, sold out of it for a nice profit. So this is one that, and it's definitely been like doing probably one of the best stocks as far as like for banking, as far as how the stock appreciation has been this year. Let's check them out real quick. And I'm not going to go too much in detail with them. I'm not going to add them to an honorable mention or anything, but I need to cut this video. I know this video is getting kind of long. So yeah, year to date, it's up around 15%. And for the year in general, and for a whole year, it's up around 38%. So yeah, this is definitely a banking stock that's doing better than the other two I talked about as far as the stock price appreciation. 32% for the year, max of the lifetime of the stock, over 1,000% right there. So yeah, it pays a nice 2.661 yield on the dividend right there, $4 a share, annually, $1 quarterly. So for the bank stocks, like I say, I'd like to have a bank stock in my portfolio, at least one, or at least like an ETF, like the XLF in a portfolio. I think the financial section is very important to have right there. Very important sector in the United States, and I like having them in my portfolio. And with Bank of America, I haven't bought nearly as much of this stock as I have with other stocks in this video, but I definitely do want to buy more of it. I just wanted to get it closer than my average cost amount right there, so I'm definitely got my eye on this one. This one's on my radar for sure. I did some buying of it on June 28th of 2023, and then the only other time in 2023 was in April. Before that, it was 2022 when I was doing buying heavily in Bank of America, and of course prior to that, I've held this company for several years right here, but I definitely want to add to the position. It's on my radar. I'm hoping that price comes down some more, closer than my average cost or below my average cost. That would be great. But if it doesn't for a while, I'm just going to steadily start adding more to it, a little bit here and there, because I should have been adding something to it, dollar cost averaging throughout this year instead of just waiting for it to get to a certain price, because it's been appreciating up and down from those levels that I've seen it at. It's been at $27, $28 per share. Now it's at $30 per share. It could be going to 32, So I'm just going to start, dollar cost averaging in there, small amounts, and if it goes down lower, then I'm going to increase that. And that is it with the video of the top 5 best dividend stocks that I've been increasing my position in and want to increase my position in. Hope you all enjoyed the video. Take care.